Well, another month has passed, and that means it is Q&A time here yet again on the channel. I put up a community post a few days ago to collect your questions for this video. We had some really good questions come in, so I'm basically just going to roll the camera for a while and see how many of these Q&A questions I can get through. So thanks to everyone who did ask a question. If I don't get to your question in today's video, I apologize. There are quite a few of them. And for anyone that's interested in asking a question for a future Q&A video, which I try to about once a month, just turn notifications on for community posts. That's where I always collect questions for these Q&A videos. So keep an eye out for that. Get in there quickly, hopefully next time, and you may well get your question answered on a future video. But before we get into some of these Q&A questions, we do have a sponsor for today's video, and this video is sponsored by Seritage. We are well and truly into tax time in many different parts of the world, New Zealand included, and Australia coming up pretty soon as well. And Seritage is a tool that I use for a couple of different reasons, one of which is tax. I can export a couple of reports at the end of every tax year from Seritage, can ship those off to my accountant, and it gives them a lot of the information that they need to do all the tax things related to my investments, and it is really a massive time saver. That's not actually the original reason I started using Seritage. The main reason was actually just to track my returns. Seritage does a really good job of tracking capital gains and losses, dividend income, and currency fluctuations to help you understand your true return from your stock market investments. It integrates with many of the world's well-known brokers, so you can import your trades directly into Seritage to again get really good return tracking, but also some nice tax reports at the end of each year as well. So I've been using Seritage personally for several years at this point. I think it's a great tool. You will have seen it featured on some videos on the channel, like the Shameless Cloner Portfolio series. So if you're interested in trying Seritage for free, head to the link seritage.com/investingwithtom. That link will also get you 4 months free off of an annual subscription if you do choose to upgrade to more premium features. And thanks again to Seritage for sponsoring the video. They've been a long time partner of the channel. But with all that said, let's get into some of these Q&A questions. Okay, so first question here is from Constantine. Hey Tom, I'm a long-time fan and I really enjoy your videos. Thank you very much. I was wondering, what do you think about the microcap environment right now? Is it a good place to start searching for potential gems as a young investor with a small portfolio, or do factors such as the high interest rates compared to the last decade and overall economic situation increase the risk to an undesirable level? Thank you for all the effort you put into your videos. Yeah, thanks very much. Yeah, in terms of micro caps and small caps and large caps and all that type of thing, I try to completely detach macroeconomics from how I think about investing in individual companies. And I'm also fairly market cap agnostic. I will happily invest in a very small company, and I'll happily invest in a very large company. I guess the thing that gets me across the line is whether I think those companies are going to be good investments, whether they offer safety of principle and an adequate return, and whether they're a micro cap or a mid cap or a large cap is really largely irrelevant to me. I would say micro caps can be a nice hunting ground because they tend to be far less followed by analysts. If you look at Apple, for example, I don't know how many analysts follow Apple, but it will be a lot, certainly lots more than will follow some small, $100 million market cap company. So you can get a real advantage in those smaller businesses and potentially find stocks that are really kind of trading at market prices that are wildly disconnected from their underlying intrinsic value, but at the same time you might get exposed generally to lower quality companies, and they can be a bit more opaque and tougher to analyze sometimes. So there's pros and cons to both. I don't really think about the level of interest rates or economic growth or something when I'm trying to weigh up whether I should invest in a micro cap or a large cap. It's really analyzing each individual company on its merits. Question here from Anonymous. Prabrai says it's taken him hours to several months to research different investments. Buffett can form decisions in seconds. Vinal says he spends 6 months minimum on each idea. That all leads to my question. How do you balance due diligence with analysis paralysis? It's a very good question. Just to clarify on that, I think Buffett has said that he can figure out whether he's interested in potentially making an investment within a few seconds. I don't know that he would fully commit in a few seconds, but he's certainly made very quick decisions before. Briar's done the same, where the investment thesis is very clear and it's a very simple business. And Rob Vinal, as you say, takes his time, but they're often on much more complicated and nuanced businesses. I really do think there's no replacement at all for just following a business for a long period of time. I've got stocks in my portfolio now that I've owned for almost 5 years, and I can tell you hand on heart that I know those businesses a lot better today than I did, in the first few months of owning them. So there's definitely merit to waiting and to researching and so on. But at the same time, some businesses are really straightforward, and most good investments you should be able to explain, in a few sentences at most. They should be quite simple ideas. They often tend to be, the best types of investments, as opposed to the really complicated ideas as well. So there's no real easy answer on that. I would say, as a general rule, as I've gone on over the years, the time that I've spent on researching a company before making an investment has probably got a little longer. But that's not to say I won't make, a really quick decision some point in the future. This question here is from Faguo. Hopefully I'm not butchering that name. Hey Tom, thanks for your great content and for consistently producing new and high quality videos. Thanks very much. Do you still follow SRG or Seritage Growth Properties? Any updates on its valuation? Yeah, I'm no longer in Seritage. Personally, I've started to put that one a little bit in the too hard basket, and I've kind of moved on to other opportunities, but I do still follow it. I think they're under 60 properties in the real estate portfolio now. They also, just the day before I'm recording this video, announced that they paid off another couple $100 million in debt. So the story of the real estate liquidation is definitely still playing out. As far as I'm aware, management haven't given any updated guidance on their $18.50 to $29 per share liquidation range. But they have said a number of times now, including in their recent quarterly results, that the current kind of macro real estate environment will impact, their asset sale prices. They're also quite a leveraged business. They do have a lot of assets, but they have a lot of debt as well. They're getting less leveraged over time as they sell assets and pay down the debt. But while they do have that leverage built in, small changes in asset values can have a big impact on the equity. So we'll still have to see how that one plays out. I am still following it, but no position at the moment. But that's not to say it's not a good investment for you or someone else. You gotta make your own decision on that. And I haven't done any recent valuation work either. So yeah, not too much to say on that front. And next question is from Compound72, and we've got quite a few questions along these lines. So when Barber spins off its units, will they be spun off as ADRs on the New York Stock Exchange or as new shares on the Hong Kong Exchange? What will the implication be on Barber holders who don't have access to the Hong Kong market through their brokers? Yeah, that's a very good question. I haven't seen any kind of direct guidance or commentary on this from management. Unless I've missed it, if I have, please let me know in the comments below. But I haven't seen any specifics on here. My expectation would be that particularly the larger business units probably would end up having their own ADR if they're just fully spun out. I think Alibaba are reasonably aware that they have a big US investor base. They have a big kind of main ADR listing on the New York Stock Exchange. So I would think they'd want to have each of their units spun off and kind of listed in a similar way, but not sure exactly how that will play out. So I think once we do get closer to some of the spin-offs, we should hopefully get more guidance on that, and it's probably worth checking with your specific individual broker once we get more detail on how that might work, how that's going to play out for your own portfolio. I would say the last thing you'd want to have happen would be, your broker says you can't access these shares, so they, sell it and just give you the cash or something. Maybe that's an option you want to do, but I don't think you'd want to be forced into that sort of position. So, I think we should get more clarity with that as time goes on, but the answer right now is I don't really know, and we'll just have to see how it plays out. Question here from Michael Bain. Would be great to hear your thoughts on A2 Milk. Do you think the current performance reflects short-term issues surrounding costs and or some COVID hangover? Or do you think there are structural issues with the business? Lots of management shuffling. Yeah, there has been a lot of management shuffling recently, including at Mataura Valley Milk, which are a recent milk processor that A2 have acquired. Mix of stuff going on at A2 Milk. So they've still got a Daigou kind of reseller channel in their Australia New Zealand business that got absolutely hammered by COVID. We've seen a lot more international students start to come into Australia, for example. I think that should be helpful for A2 Milk to start getting that business back up and running again. But at least as far as I'm aware, it's certainly not back to where it was. But at the same time, we've had A2 come out fairly recently and say that they've got strong double-digit growth currently happening in their China label business, which is really good to see. I saw some info on Twitter that imports of New Zealand infant formula into China are up something like 80% year over year. How much of that is specifically an A2 Milk product? I don't know. We'll kind of have to see how that plays out. But at the same time, they've got a very strong balance sheet. They've got a very minimal amount of debt. They've got a lot of cash, and they've just completed their first kind of significant share buyback program. And share buyback programs are pretty rare in New Zealand as well. So, there's a lot of positives and a lot of negatives kind of happening at A2 Milk. Again, I've said a few times in this video, but we will really just have to see how it plays out. New Zealand companies only report earnings typically 2 times a year, but since Synlait reported some less than ideal results, A2 Milk have come out and kind of reassured the market, confirmed their guidance and so on. So I think there's definitely still good demand for the product. It seems like margins will be a little weaker in future than they have been in the past, which obviously hurts earnings. But it'll be interesting to see how the results play out for the rest of this year and into the following year as things hopefully start to really recover from COVID, particularly in that Daigou reseller channel. Question here from Joe. Have you bought or sold any options to date? If so, how did it pan out for you? No, I still have not bought or sold any options to date. I'm open to doing it. There's specific companies on my watch list that if they got to certain prices, I think I would sell put options on those businesses as a strategy to hopefully get a lower cost basis as I enter into those positions, but it's not something I've implemented just yet. So not too much to share on that front. Question here from Matt KG. What is compelling to me about index investing is the ability to continually compound all available investing money. I find it difficult to compare whether this would be better than value investing, where you may be sitting on cash for long periods of time before putting the money to work. Any tips on how to figure this out? Very good question. Again, it's not one that I can give a super clear answer on. But if you follow sort of a Buffett Munger style value investing strategy, there will likely be periods of time where you have cash sitting on the sidelines. Now, for the past decade, there's been a pretty big opportunity cost to doing that. The market most of the time goes up. It might not have felt like that over the last year or two, but most of the time stock markets generally, do tend to go up. And if you have cash sitting on the sidelines earning next to 0%, then there's a real opportunity cost to that. That equation's changed a little bit in the past year because you can now actually earn somewhat reasonable rates of return on cash, potentially getting back to real returns like the gain you're getting on cash, interest and so on is greater than the rate of inflation. Depends where in the world you are exactly, but in many cases that is now starting to happen. So the opportunity cost isn't quite as large, but the whole idea is basically you would be able to put that cash to work and earn a rate of return that will more than compensate for that period of opportunity cost. So instead of having all your money in an index at all points in time and earning 7 or 8%, maybe there's a period of time where you have cash sitting there earning call it 2% just for argument's sake, and then there's another period of time where you're able to invest that cash in some sort of really distressed price, great business, and maybe it earns 20% a year and far more than compensates for that opportunity cost. That's kind of the idea. But again, earning 20% a year is obviously not guaranteed. But I should also say, earning 7 or 8% in an index fund over a period of time isn't necessarily guaranteed as well. But those are kind of some of the competing factors. I know some people out there will argue for investing idle cash into an index fund, trying to have sort of a combination of both of the strategies, being a value investor at heart, but putting idle cash into an index fund to, have all available investing money compounding at all times. I can see the argument for that, but the real big negative is, if we do run into some sort of crisis, like take March 2020, for example, where you'd want to take some of your idle cash and invest it in great businesses at very cheap prices, at the exact time that you're going to need that cash, your index funds are also going to be down, and your sort of buying power for the great businesses in a value investing style is going to be greatly diminished versus if it were just sitting in cash, earning nothing, but not getting eaten away by short-term declines in markets. A question here from I'm Exotica. Why would a company like Ferrari that trades at 50 times multiples of earnings buy back its shares? Very good question. I think the short answer to that is they've just completely run out of options to invest money, and they would, for whatever reason, rather do share buybacks than pay a dividend. I don't know if there's some sort of management compensation thing there where management are incentivized, on an earnings per share basis or something. Maybe that's what's going on there. In which case, there'd be incentive for management to try and shrink the share count over time. But I don't know. Buybacks at really high multiples of earnings can make sense if the business is worth more than that really high multiple of earnings. Like if you're buying back shares at 50 times earnings, but the business is worth 100 times earnings, could still make sense. Is Ferrari worth 100 times earnings? I doubt it. But that would be, I guess, the logic that would mean that does make sense. It's really tough with a lot of these mature businesses that throw off a lot of cash flow. It's a high-class problem to have, as Charlie Munger would probably say. But you can only invest so much money into a business and growing the company and earn good rates of return. At a certain point, you do have excess cash and you have to make a call about whether you want to pay a dividend or buyback, make an acquisition. There's advantages and disadvantages to all of those things. One of the advantages to buybacks is you can increase the intrinsic value per share of the business if you can buy back undervalued shares. But there's also no ongoing commitment to keep buying back stock. Whereas if you start up a regular dividend, there in many ways is sort of a requirement in a lot of investors and companies' minds to keep the dividend going for a period of time. And obviously acquisitions can be risky as well. So I sort of wonder if it's maybe the least worst option that Ferrari saw. I don't quite know the specifics on that situation, but in most cases it's probably going to be pretty hard to justify from a valuation standpoint buying back shares at 50 times earnings. Okay, let's take one last question. This is from Venushka. Hey Tom, how can I calculate intrinsic value of stocks such as Bank of America and American Express? Does Warren Buffett's suggested free cash flow method work for these financial institutions? Financial institutions can be interesting ones to try and value. I do have a bank intrinsic value kind of video on the channel. I'll try to link that in one of the corners here if you want to check that out. Banks are very unusual businesses, and American Express, I don't know quite as well, but a lot of financial institutions tend to work in the same way, where they have basically a core, banking business, which is really like a spread business. You pay some money out to people who will give you cash, people with deposits in the bank, and then you lend money out, to loans, and you capture a rate of interest on that. And hopefully the interest you're capturing on loans is a little higher rate than the interest you're paying on your deposits. You capture that sort of spread. And the way that you grow a bank over time is you grow the deposits and you grow the loan book, or the asset side of the business as well, and your equity kind of in the middle needs to grow at a similar rate as well. banks are very leveraged institutions, but there are limits on how leveraged they can be. So in order for you to keep growing your deposits and keep growing your loan book, your equity or your book value has to be going up at a pretty similar rate as well. So a lot of people prefer to value banks on a book value growth basis, so looking at what sort of return banks can generate on their assets, how leveraged are they, how much of their earnings are they retaining each year for future growth, and how much are they paying out as dividends and so on. So there's a few sort of different moving parts there, and it is a little different from analyzing a more traditional type of business. But again, I've got a video on it if you want to see the details here, so be sure to check that out. Okay, so those are all the questions we have time for in this one. Thank you very much to everyone who did ask a question. I really appreciate it, and there were some great questions that came through in this month's Q&A. Like I say, if you want to potentially get a question answered in a future Q&A video, turn on notifications for community posts here on YouTube. That's where I always collect the questions. And if you get in there quick, you may just get one answered. So thanks very much for watching. If you did enjoy the video and haven't subscribed to the channel already, please be sure to do so, and I will see you on the next video. Cheers.